Hey y'all, we're going to start with a high-level overview of the profit and loss statement, including the different sections of a profit and loss statement, what the major line items are in the profit and loss statement, and then we'll get into the different ways that you can analyze your income statement. So let's get started. First, we see that we have January through September for the income statement. As I mentioned before, an income statement is going to be over a period of time. That period of time can be 1 day, 1 month, 1 year, 10 years, the life of the business, anything. Generally, what we see though is that the most useful form of a P&L or income statement is year to date with a breakout monthly. So we have that here. As you can see, we have January, February, March, April, May, June, July, August, and September broken out. Now, why don't we have October? So the process of books is that they have to be closed after the month is over in order for us to report them to the financial statement. In order for that to happen, your accountant or bookkeeper needs to make sure that every transaction that was logged in your accounting software, usually QuickBooks or Xero, went to the right account. So what do I mean by account? If we look over here at the column A, we can see all these different accounts here with numbers in front of them. These are different accounts, and there's different types of accounts. Why does it start at the 4000s or the fours? This is just a nomenclature that dates back hundreds of years, but the balance sheet actually has the 100s, 200s, and 300s. The 400s is where revenues typically start. So we have 3 revenue accounts. Then we have a couple of cost of goods or cost accounts. And then we have some expense accounts along with some other accounts down below. So we're going to get into those in a second. But the way that a P&L usually starts is with the income at the very top. Now, income is kind of tricky. Some people have heard of the term revenue recognition. But basically, books can be in one of two forms. They can be in cash basis or accrual basis. In a cash basis, which is what a majority of small businesses are, is that a business will recognize that it has got revenue when cash comes in the bank. Now, that's okay, that works, but the proper way to look at an income statement is through the accrual basis, which means that as soon as the revenue has been recognized, it goes on to the income statement. And that doesn't necessarily mean that you have received the cash yet. So for example, if you do a bunch of work for somebody, but they haven't paid you yet, you've technically earned or you can recognize that revenue even though they haven't paid you. Maybe they have terms like net 10 or net 30 or what have you. This has been done in the accrual basis, which means that we are recognizing revenue once we've earned it, not once we've collected the cash. Totally separate topic for another video. The first one we have is project revenue, and then we have monthly services revenue, and then we have other income. Now, why do we have multiple revenue accounts? The reason we have multiple revenue accounts is that you often want to break up your revenue depending on what kind of visibility you want into the business. So for example, in this business, because it's a service business, we have 2 different types of work that we do for clients. We have project work and we have a monthly retainer that other clients are on. Now, why did we break those up? Well, if you think about it and you're a business owner of a professional services business, you probably want to keep track of the type of revenue that you're getting that's recurring, that's on a retainer or some sort of contract. And you want to keep that separate from project work, which is more of a one-time thing. Now, how you break it up, whether you put project revenue above or monthly service revenue above, kind of depends on the logic of the business. In this business, for example, what we're going to decide is that project revenue is usually a lead into people becoming a monthly service client or getting onto a contract with us. So we consider this more like kind of top of our revenue funnel. And we consider this more of like our standard recurring business that is a little bit more stable, a little bit more sustainable, and ultimately easier to forecast, which helps us determine what sort of additional hires or other like fixed costs we'd want to bring on in the future. We also have this third one, which you'll see in a lot of businesses. It's an other income account. We put it down at $4,900. The reason we have this account is that occasionally we're going to do work that doesn't necessarily fall into the bounds of our normal work, but isn't completely out of scope. It's not something that would never happen. It's just something we maybe don't do that often. So we like to have a bucket for other revenue that maybe doesn't fit in our normal lines of business. And this is here in the 4,900 other income account. What we can see is that we have this line called total income, which is where we sum up all of our different revenue accounts. And so we can kind of see how these go month by month. And we'll get into some of that horizontal and vertical analysis in a bit. So this is the top of your income statement usually is your revenue accounts. Now below that, you're going to have your COGS, cost of goods sold, cost of sales, direct cost. Different people call it different things, but it's really important to note that there are two types of ways that you spend money. There are your costs and there are expenses, and they're very different. Costs are basically things that are associated with the delivering of your product. Since we're a service business, we're going to say that we have some sort of labor associated with services that we do provide. And we have labor that's associated with our project revenue and labor that's associated with our monthly contracts. So we're going to call those costs of goods sold or costs of service. Those are separate from expenses. Expenses apply more to the overhead of the business that can't be directly tied to one specific type of revenue. So for example, your rent is going to be the same regardless of whether you have 10 clients or 30 clients that month. And so that's an expense that applies to the overall business. So it's going to sit down here in our operating expense accounts, which we often refer to as OPEX. So we've got our direct costs, and within this business, we have two types of direct costs. We have employees that we hire. We pay them regularly. They're on either a salary or some sort of hourly wage. And then we've got contractors, which are people that we do 1099ing with. So people that we bring in for a project, we bring them in at a certain rate. And we like to break out those two different types of expenses because those can be slashed almost immediately. Whereas our employee expenses, they don't scale as directly. We don't just hire and fire people. That's a much more serious decision. So we've got our cost of goods sold. And what happens is you get a total for your cost of goods sold by summing up your direct costs. And when you subtract that from your total income account, you get what's called gross profit. Now, we talked a lot about the efficiency of a business. With gross profit, what you want to, the way I think about that, the way that I frame that is that gross profit are the number of dollars left over after you service or earn the revenue that you've generated in your business. So after you've paid for all the labor required to say, okay, I have fulfilled my obligation to the client, this is now earned revenue, I have this many dollars left over after paying for all that labor and material, that's going to be your gross profit. The gross profit is what you have left to cover your operating expenses. Gross profit is also where you decide how efficient your business is, and each industry is different. So in a grocery business or a manufacturing business, you have very small gross profit because there's a ton of expenses and it's more of a volume business. In this business, however, the professional services business that I have laid out, gross profit's going to be a lot healthier. It's going to be a lot bigger. It's going to be more as a percent of revenue because there are less fixed costs. Our labor is somewhat scalable. And so we're going to talk a little bit about what the gross profit looks like over time for this business. After you've got your gross profit, it's time to look at your operating expenses. These are also referred to as overhead. And generally, it's assumed that these things are relatively fixed or have what's called a step functionality to them. So generally, these expenses scale a lot more slowly. Rent is relatively fixed. Maybe it goes up every year, and that's called a step function. Maybe your people costs are a little bit more stagnant. So if you have a CEO in your business, you're not going to hire two more CEOs just because your company doubled. Your one CEO may get paid a little bit more, but you're not going to get more of those. You're generally going to have one CMO or one marketing person, or maybe you hire an additional marketing person every time you want to ramp your business by another 30 or 40%. Operating expenses don't scale directly in proportion with your revenue, which can be a good or bad thing, right? Now, we sum those up and we get total expenses, and we see that here. This is summed up here. This is summed up here. Our formulas are correct. And after we subtract our operating expenses out of our gross profit, we have a line called net operating income. This is the amount of income that's left over after we've paid all of our costs and we've paid all of our expenses. This technically is what's left over in the business after all that revenue has been recognized and all of our expenses have been paid. There are other expenses that a business incurs, which is why we call it net operating income. and not net income or net profit. This is the net income left over after the business operations have been fulfilled and paid for. Now, we have below that this little weird thing called other income. Other income and other expenses exist because there sometimes are other one-time events that occur that create income and create expense. So for example, let's say you owned some land or you owned a building as a business and you decided to sell it. That's not the line of business that this professional services firm is in. So it's going to be categorized as other because we have to recognize that it happened, but we also know that it's not going to occur again or isn't likely to occur again. So you want to have this bucket here for these one-time things that create expenses and income for you. So we have our other income and we have our other expenses. And then there's this one other line here called interest expense, which I want to talk about briefly. Interest expense shows up below your net operating income, but it is an expense of the business and it's the financing cost of the business. So if you took out a loan in order to start your business or to grow it, the interest expense is going to show up on your P&L and affect your net income's profitability. Now, why is it called interest expense? Because we don't book the principal payment of the repayment of that debt on our P&L. That shows up on our balance sheet later. But the interest part, the cost of the financing that we've taken on, does affect profitability. So it shows up down here in this interest expense account. After we've got all of our other income and other expenses, these guys here, after we sum these up and we cancel out the other income and other expenses, that gives us our total net other income. And then that gets subtracted from our net operating income to give us our net income. This is our bottom line, as it were. Now, in most small businesses, net income doesn't tell the entire story. You still have to pay taxes on that net income. And oftentimes, owners take what's called a draw, meaning instead of paying themselves a salary, they pay themselves a draw. Now, when it gets into whether you're going to sell your business or you're going to hire other people, or if you want to figure out how valuable your stock is, then you need to do some other calculations to figure out something like earnings before owner's compensation. But the principles here are that if you haven't paid yourself a living wage or what would be necessary to replace you, then we still need to pull that out of our net income. However, if you are paying yourself a salary that would be commensurate with your value in the marketplace, that would show up here in people OPEX. And so we would be able to say that this was actually the net income of the business. And so we see net income and we can see how it performs month by month. And that gives us an overall structure of a P&L. So overall structure of a P&L is that we've got our income accounts, we've got our cost accounts, we get gross profit from that. Then we have operating expenses. Once we pull those out of gross profit, we have net operating income. And then after that, we take out our other income and other expenses to get our net other income. We take the net other income out of our net operating income to get our true net income or bottom line. That's net income before tax. And that gives you the structure of an income statement. Now, let's go over to the different ways that we can analyze this income statement to pull some insights out of the business. There are generally two ways that we can do P&L analysis. The two ways are called vertical analysis and horizontal analysis, and they're named very accurately because what we mean by that is horizontal analysis is looking across periods, and vertical analysis is looking at one period as a percent of some base number.